best stock company? To select a good stock company requires a structured approach that aligns with your investment goals and risk tolerance. Below is a step by step guide to help you make informed decisions when choosing stocks in the Indian market. 1. Define your investment goals. Before selecting a stock, clarify what you aim to achieve. Long term investment. Focus on companies with strong fundamentals, stability, and growth potential for wealth creation over years. Short term trading. Look for stocks with high liquidity and price movement to capitalize on quick gains. Your strategy will vary depending on whether you prioritize growth, income, or short term profits. 2. Analyze sectors with growth potential. Start by identifying sectors likely to perform well in India's evolving economy. Economic trends. Sectors like IT, renewable energy, and infrastructure often benefit from India's digitalization and development focus. Government policies. Initiatives like Make in India or renewable energy targets can boost industries such as manufacturing and green energy. Global factors. Export oriented sectors, e.g., pharmaceuticals, IT, may thrive with favorable global demand. For example, if India's renewable energy push interests you, explore companies in solar or wind energy. 3. Evaluate company fundamentals. Once you've shortlisted promising sectors, assess individual companies using these key factors. Longevity. Opt for companies with a solid history in products/services likely to stay relevant, e.g., fast-moving consumer goods or healthcare firms. Financial health. Earnings growth. Look at earnings per share, EPS, trends over 3 to 5 years for consistent profitability. Debt levels. A debt to equity ratio below 1 indicates manageable debt. Cash flow. Positive cash flows signal financial stability. Management quality. Research the leadership team's experience and track record. Long tenured, shareholder friendly management is a plus. Competitive advantage. Moat seek companies with unique strengths like strong brands, e.g., Tata, patents, or high customer loyalty. Growth prospects. Investigate plans for expansion, new products, or market entry that could drive future revenue. For instance, a leading IT firm with consistent revenue growth and low debt could be a strong candidate. 4. Assess valuation. A great company can be a poor investment if its stock is overpriced. Use these metrics to evaluate. Price to earnings PE ratio. Compare with industry averages. Lower may indicate undervaluation, but context matters. Price to book PB ratio. Useful for asset-heavy sectors like banking. A lower ratio might suggest a bargain. Dividend yield. For income seekers, higher yield from stable firms, e.g., utilities, are attractive. Avoid stocks with inflated valuations unless justified by exceptional growth potential. 5. Consider technical factors for short-term trading. If you're trading rather than investing long-term, focus on liquidity. High trading volumes ensure easy buying and selling. Check stocks on NSE/BSE. Volatility. Stocks with moderate price swings offer profit opportunities without excessive risk. Chart patterns. Use indicators like moving averages or relative strength index, RSI, to spot trends or entry/exit points. This step is less critical for long-term investors, but vital for traders. 6. Diversify your portfolio. Reduce risk by spreading investments. Across sectors, balance exposure, e.g., IT, banking, consumer goods. Across sizes, large cap stocks, e.g., Reliance, offer stability, while mid/small cap stocks provide growth potential with higher risk. Diversification helps cushion against sector-specific downturns. 7. Stay informed. Stock performance is influenced by external factors, so monitor company news, earnings reports, product launches, or leadership changes. Economic indicators, GDP growth, inflation, and interest rates affect market sentiment. Political and global events. Currency fluctuations or policy shifts can impact export heavy firms. For example, a weakening rupee might benefit IT exporters but hurt import dependent companies. 8. Use reliable research tools. Access data and insights from trusted Indian platforms. Money control, financial statements, stock quotes, and news. Screener.in, custom screens for fundamental metrics. Ticker tape, company analysis and peer comparisons. NSE/BSE websites, official stock data and reports. Beginners might also consider large cap stocks or index funds, e.g., Nifty 50 for a safer entry point. Additional tips: risk tolerance. Only invest what you can afford to lose. Stocks carry inherent risks. Corporate governance. Favor companies with transparent, ethical practices to avoid fraud related losses. Tax implications. In India, short term capital gains held less than 1 year are taxed at 15%, while long term gains greater than 1 year are taxed at 10% on amounts exceeding 1 Indian rupee lakh. Avoid penny stocks. Low price stocks are tempting, but often risky due to volatility and low liquidity. Putting it together, imagine you're eyeing the renewable energy sector.